Today, folks, I did a thing. I sold out of XEQT in favor of VDY, ticker VDY, my monthly paying Canadian dividend ETF until I die, baby. And I want to explain to you why I've made this decision as I've been rebalancing into the latter half of 2025 just to finish the year up as we review my T to the F to the S to the A, my R to the R to the S to the P, look at my registered account performance as I've got the October updates that have been absolutely crushing the average finfluencer clown you're going to find on YouTube, Blossom, you name it, baby, and you should be whopped upside the head. So many of you out there just detriment your own performance by focusing on really dumb things and not having like a proper strategy in place. And I want to talk about how to strategize a little bit better because there's no excuse for you not to be making 15% a year, at least. I can't guarantee that moving forward, but my God, if you haven't got it for the last few years, slap upside the head, and I'll explain to you why. But my accounts, my TFSA up 18% annualized, jumping up from 17% thanks to the Google trade this year. My RRSP 29% annualized a year, only thanks to the amazing pivot of getting rid of the Schwab US Dividend Equity ETF in favor of the S&P 500 right in the midst of that tariff war, because I am up 25% now on that VOO position, and it's taken the account to new all-time highs because, man, back in 2019 when we had that beautiful Tesla trade that gave us most of those returns, the dumbest thing I did was put it in SCHD and give up like 4 years of growth because this should be like 35% annualized at least. But we're going to break these accounts down and even look at my corporate account and all that just to give you guys full transparency as the king of the finfluencer clowns on this platform. And join me on your financial journey by hitting that subscribe button, folks, because we got a lot to get into. And let's start off with the returns before we look at the investment theses behind VDY over XEQT. Firstly, the T to the F to the S to the A, 306%. I have 3x'd my capital in this account since 2017, just over 8 years, against the S&P that is up 183%. There's been a lot of history behind this account, and I'm not going to get into it right now, guys, but I'm glad that I have narrowed my strategy down to a mantra that now works for me really successfully, which is cost average into the many and focus on the few, baby, because that's what we've done in these accounts, and it has absolutely crushed. The biggest pivot ever was selling out of all my individual stocks, realizing no one intelligently can manage a 20 or 40 stock portfolio. And in the crash of 2022, I got a little paranoid about what is going to survive because I can't understand Pepsi's supply chain. I can't tell you how financial institutions work, but I can sure as hell tell you how Google and Meta work. So why am I buying all these stocks when I can let a market cap weighted ETF comfortably decide that for me over time? And you can see my accounts went down quite a lot, at which I took profit here and actually liquidated my TFSA to purchase a piece of real estate in 2023. And come 2024, I started rebuilding the account back, at which we've almost maxed it back out. But look at the propellant that's been going on here thanks to this bull market. And my registered retirement savings plan, as mentioned, we're up 365%, doing much better than my TFSA because this account's been around since 2019, really outpacing the S&P that's only up 129% in the same time frame. But all of those gains coming from that beautiful unicorn catch of Tesla just before that epic bull run, but again, severely detrimenting the account by buying SCHD and having no returns basically since 2021 up till basically 2025, right? So I'm very thankful I was able to pivot. I did the right thing. I usually give it about 3 to 5 years. I look at my investments, and if they're not keeping up to the performance of my expectations, it's time to let it go. I'm not married to these investments, guys, and I know some of you think I'm a flip-flopping clown, but materially, I don't make a whole lot of moves in my accounts. Like, they're fairly immaterial for the most part. XEQT even wasn't that big of a position, so I'll explain why in a moment. I don't talk about my corporate account as much. In this account, I've been playing around with some small caps, doing some things that have detrimented, and some good things like Google and Meta in here, even though Meta's given up a lot of the gains so far this year, kind of bouncing back a bit now. But this account is still up 75% since May of 2021 against the S&P that's only up 70%. So we are just slightly outpacing the S&P within this account. But let me just talk to you guys about the decision making behind my pivot out of XEQT. And it just comes from the sense of diversity of just trying to concentrate the stocks that I love a little bit more, but also kind of move away from the United States because, again, the US is quite an expensive market, and I've come to realize that I really like the idea of buying into global markets with XEQT, but the reality is I'm still hyper upperweighting the US markets by like almost 50%, and that was really taking my accounts from like, the 64% to over 70%, I was getting close to, I think, 10% with XEQT, and I was just like, man, this is just continually concentrating the same markets, even even though I love China and Alibaba and Taiwan Semiconductors, I'm really not getting any of those weightings at all. And over time, I do want to broad scale into the global markets, but as someone who's 33 years old, I can afford a bit more concentrated risk. And I really, really like VDY, and I've come to realize that I could upperweight some of these stocks and they'll be more in line with some of the upperweighted S&P companies. And I want to explain to you why this is, but before we do that, guys, I just want to scroll up and remind you of the returns that have been nothing short of insane, like disgustingly insane. And it bothers me so immensely in these peculiar bull markets how people will go focus on the less returning assets just because they offer higher yields. I mean, look at this. The 3-year annualized return of the S&P 500, guys, has been 22%. If you haven't been getting 20% a year over the last 3 years, you, my friend, are a clown. You're not a good financial investment advisor of your own self, and you should probably hand your capital off. And I know it's a harsh reality, but I don't think people hold themselves very accountable to the market average. And they're like, I'm not trying to get market average returns. What are you trying to get? Less money? Okay. Like, I get owning some GICs and removing some of the volatility for safety if you're closer to retirement. But my God, guys, this has never happened before. You're going to go through one of the greatest bull markets literally in history, and you're not going to get the bag because you're just too caught up in your own stupidity, right? I mean, look at the 15-year annualized returns have been 15%. 15% a year for 15 years. Are you effing kidding me? Nothing short of exceptional over the last 5 years if you've just been cost averaging in the S&P. Look at VDY here, guys. VDY, if we scroll up right now and we take a look at those returns, the last 3 years have been 16.8%, 5 years, 20%. And since inception, guys, 11% annualized. This disgusting. And what's really great about these two stocks overlapped, especially in the last 5 years, while VDY has been outperforming the S&P 500. These two stocks paired have actually removed the volatility a lot and have bumped up the extra dividend yields to help you continue to cost average, which again, nothing short of exceptional. I'm not chasing the yield here, of course, but one of the main reasons I've also upperweighted VDY is if we scroll down and I'm able to make VDY 30% of my portfolio with these upper-weighted stocks like Royal Bank that is 15%, you're going to have to cut that by 3, right? So Royal Bank would technically be 5%, Toronto Dominion would technically be 3%, and then with this huge amount of capital I have in VOO, we'll say like 60%, 65%. If we scroll down and take a look at those upper weightings yet again of VOO here, guys, we can see 8% is sitting in NVIDIA, but we have to cut that down almost by just, half, right? Because only just over half of my portfolio is in the S&P. So that means NVIDIA is actually closer weighted to about, what would that bring it down to? Probably 5% at a 60% weighting. So that would put it more in line with like even Royal Bank. So it's upper weighting some of these Canadian stocks while also kind of de-weighting NVIDIA. And it's just balancing the portfolio out a bit so I'm not just so concentrated in tech. And then what I like to do, guys, is focus on the few. I'm not a genius. I can't tell you Pepsi's supply chain and how they're making Doritos, and something tells me you can't either. Do you know how Starbucks works, where their coffee beans come from, the cost of coffee beans? No, you're an absolute degenerate clown who's just buying 20 or 40 stocks, having no idea how to properly manage them, whereas I fully feel like I understand how Google operates. I feel like I fully understand how Meta operates. This is my job. I live on YouTube. I understand Google Ads, the thing driving $50 billion of revenue for the company. I use Google Ads on a daily and manage like literally almost 100 client like ad distributions. Like, it's crazy to me how integrated I am into the system, which is why I'm so comfortable and was so comfortable buying Google on the dips. And same with Meta, right? Like, these are stocks you have to understand when they tank. I have a good familiarity with them to the point where I'm comfortable enough to know when it's appropriate to buy and sell. I can't do that with 99% of the market. So why not let the average of the many figure themselves out? Like, if NVIDIA starts to underperform, guys, I don't need to worry about it because it'll just naturally de-weight its way out and I don't have to worry about buying or selling it. And I don't think anybody to a real extent over a 20 or 30 year period will outperform a market cap weighted system. And the best part about focusing on the few is, let's say Google drops in half. Okay, so I lose an extra 3% of the account. That's not the end of the world for a guy who's 33 years old who can be more growth oriented, right? But don't get me wrong, over time I am focused on wealth preservation and I do want to start adding in some of the emerging markets and maybe just start putting all my capital moving forward in XEQT. But in the meantime, guys, I just want to finish kind of filling out the accounts as my, my portfolio runs up closer to 600K here. And I would like to see about 30% VDY, get this closer to 60% VOO and then keep my Google and Meta position that pair nicely with my fiance's account. And the reason we don't buy the Qs, guys, which a lot of you ask me, like, am I better off just buying a QQQ ETF, like a tech-oriented ETF? And yeah, that might be better oriented for you, but I feel like because of my S&P concentration right now, where like the top 10 stocks make up 40% of like all of this ETF, which is also incredible. I just feel like I've got a lot of tech exposure, and I don't want to buy another ETF that continues to concentrate them when I don't feel like I trust NVIDIA long-term. I don't like Tesla all that much these days, but I do like Meta. I think it's cheap. I do like Google. I think it's cheap, and it brings down the overall price to earnings multiple of my entire portfolio. And I feel like if anything, de-weights some of the risk because I feel like I understand that part of the market better. Now, time will tell here, but what I do like is Google and Meta are obviously the upper weighted positions of our accounts, because if we look at the upper weighting position of Google or even Meta in here, right? Like there's two Google shares. We have Google A and C. Between these two shares, they make up 4.5% of the S&P. Cut that in half, we're closer to obviously 2.5% with my 65% weighting. So if we take the technical weighting of Google and add it to the individual weighting that I have, you can see Google's actually technically closer to about 8% of my entire portfolio. And I'm very happy with that, right? And because of that, now we have upper weighted Canadian stocks from VDY, which are my favorite, right? Like the Canadian banks are super resilient. Enbridge, I love getting these upper weighted exposures that help reduce some of the volatility, because Canadian stocks are just a lot less volatile than some of these tech companies. So I feel like it's going to not only balance out some of the volatility, but increase the yield a bit. I'm quickly approaching 10,000 in annual dividends, and I feel like a lot of those covered call and yield chasers out there are looking and being like, you could just retire off dividends with your portfolio. But I'm here to chase the bag, baby. I'm not giving up on the greatest bull market in human history to chase yield and underperform the market. Are you effing kidding me? Come on, guys. Pah! Slap you upside the head. You deserve it sometimes. But if we take a look, I know a lot of people were concerned with the VDY dividend here because it has actually been decreasing over time, and that's been concerning a lot of people. And I know if you're in retirement, I still recommend focusing on total returns, but maybe leaning more toward income, more maybe treasuries, GICs, and something to remove even more volatility from the markets. But regardless, the reason the dividend's been deteriorating a bit, guys, is because we are in a growth-oriented market. And what ends up happening is stocks, though they pay dividends, if they're in a growth phase, that yield is going to go down over time. And because these are market cap weighted systems, if stocks that pay less yields but are performing better, they're going to work their way up the list and actually remove maybe some of the higher yielders. But in this case, would you rather have higher exposure to Royal Bank or BCE? Like Bell has been crushed. And if you were just chasing yield, you have completely got destroyed. So you got to keep that in mind. Let the system work itself out. Don't just be dividend oriented, guys, and build a portfolio that you think can sustain incredible returns to fast track your financial independence. Because at the end of the day, guys, I don't care about yield. You're not going to show me a yield when your total portfolio is nowhere near the bags that I'm pulling in, and I want you to do something similar. I just want to see you do your damn best, guys. Even though I'm here to do my best and hopefully give you some transparency in it, at the end of the day, I want the community to thrive, because there's too many people out there struggling, and if you're not part of the investor class, you're going to get left behind in this new world that we live in, where AI is probably going to wipe your job out sooner or later. And it reminds me of when Bell laid off all those employees and then increased the dividend, which was insane to me. It just shows to you that investors are priorities over employees. So make sure you're part of the investor class. And if you want to talk one-on-one, go to kylelivingston.com. You can support the channel. Go check out the products I have there. But otherwise, I'd love to know what you think in that comment section below.